Good afternoon, everyone. Thank you for joining us for this installment of Epic Insight. This is Chris Colangelo, Marketing Manager here at Epic Retirement Plan Services, and I'll be your host for today's call. We're excited to be joined today by Spiro Priavolos, President of Penn Checks Trust, to share with us everything you ever wanted to know about missing participants. Since joining Penn Checks in 2002, Spiro has held several different positions, including Director of Operations, Director of Sales and Marketing, and most recently, VP of Strategic Development. In his current role as president, Spiro's primary focus is on growth, cultivating strategic partnerships, and initiating the development of new products and services to keep the company at the forefront of the rapidly changing retirement plan industry. In 18 years with Penn Checks, there's not much Spiro hasn't seen when it comes to distribution and missing participants. As a reminder, your line will be muted throughout the call, but if you have any questions you would like addressed at the end of the session, please enter them in the webinar control panel. With that, we'll turn it over to Spiro. Spiro, take it away.
Thank you, Chris, very much. Hey, good afternoon, everybody. Thanks for joining us. So today's talk is Missing Participants, WTF, which stands, of course, for Without the Fuss. In the demo, I promised everything you'd ever want to know about missing participants. I don't know that it'll be everything you ever want to know because we've only got 30 minutes, but I will try and fill you guys' heads with as much good information. I think that'll give you a good idea about missing participants. So let's jump right into it. Here's what we're going to cover today. Some of the really basic stuff, just kind of right off the bat. Obviously, what are missing participants, but really why they're a problem. We'll talk about how they happen and who benefits. Then we'll get into some legal guidance and what exists out there related to missing participants so that you're aware. Then we'll talk about resolutions, really what should be done, best practices, preventative measures, and then I'll give you guys just some bonus content towards the end, and we'll talk about the PBGC's entry into the missing participant business, and we'll also talk about how you might be able to grow your business with missing participants. So with that in mind, like I said, we've got about 30 minutes, so we'll fly through a bunch of this stuff. I could talk about this stuff forever, and again, I have really seen it all when it comes to missing participants, and it is a funny part of our business. But at Penn Checks, it's obviously a big piece of what we do. So I'll tell you some stories along the way, and you're all on mute, so I can't hear you laughing at my hilarious stories and anecdotes, but I'll just pretend in my head that you all are. So with that, up front, what are missing participants? Why do I even talk about this? Because there actually is some discussion about this, and people ask me this all the time. Well, what if somebody's just non-responsive? So basically, I'll say this. A missing participant is a former employee who's got a balance in the plan. This is important. The plan sponsor may or may not even be aware that they're missing. And I mentioned a second ago, right? People ask us, well, what about a non-responsive participant? Here's our position on this. We kind of think that best practice is to treat everybody the same. If you've sent out notices to somebody's home and those that mail hasn't come back returned undeliverable, we know that there are some people out there who say, well, we just consider that a non-responsive participant. Or even if you send a certified letter, somebody may feel good about that. I think you're on much better ground there if that's your practice, and that's fine. But again, for our purposes, we kind of believe that, again, best practice is, look, if you can't get a hold of somebody and you really don't know, best to treat everybody the same and give everybody the same standard of care as a missing participant. Because again, anybody can sign for a certified letter. It doesn't mean that it's actually the person that it was intended for. So that's the basics on what a missing participant is. I mentioned uncashed checks there on that bullet. In a longer version of a talk about missing participants, I do include typically a lot of information about uncashed checks, because the reality of uncashed checks is that they're just another form of a missing participant, if you will, right? The only difference there is one went missing before a benefit was paid to them, the other went missing after a benefit was paid to them. You may hear me reference one or two things about uncashed checks through the presentation, but I will try to keep it focused on missing participants. Okay, why they're a problem? Number one, they represent an ongoing fiduciary responsibility. Obviously, they can increase expenses in a plan. That's an issue. They are certainly a liability if they're mishandled. And then another big one, if you need to close a plan, it really complicates that issue because you can't close the plan unless you can pay everybody out, and it's hard to pay missing people out. So, okay, how do they happen? This is actually one of my favorite things to talk about because they happen for all kinds of reasons. The most common, though, is just a former employee participant. They move, they don't provide a forwarding address, and they forget. Typically, this happens with younger employees, people who may not even realize that they had a balance in their plan, potentially plans that have an auto enrollment feature. Sometimes younger employees just aren't aware of that stuff, and they end up moving and doing their thing and not even realize that they had a balance. So that's the most common reason. But certainly employees, they will ignore correspondence from a former employer. Sometimes they didn't leave on good terms, and so anything that comes from their former employer goes right in the circular filing cabinet. So that happens. Records do get lost through M&A. That certainly is something that as companies grow in size, it becomes legacy records do get lost in the shuffle. Death is interesting. Death happens, I think, to everybody as far as I know so far. So people die. Incarceration, people get incarcerated and are out of touch a lot of times. We get a fair bit of that. And then the last one of my favorites, people who either need or want to disappear. We've got, we've kind of heard everything from A to Z from people who we've been told that, oh, that person's in witness protection now, and you might as well just forget about that person. We've also been told about people who have disappeared not of their own accord, not willingly necessarily. So again, you hear all kinds of interesting stories, but so people disappear for all kinds of reasons. All right. Real quick, how many missing participants are there? It's a good question. Right? It's difficult to determine because there are no official statistics on this stuff. There's nothing that you report. How many missing participants do you have on your Form 5500? There just isn't information on that. The other issue is that the figure is constantly changing. Right? Plans are coming into and out and going out of existence all the time, and people are surfacing and disappearing all the time. So the takeaway from this slide is to be sure that the number is big and it is a real issue, right? Otherwise, there wouldn't be an entire industry around this issue. Okay, who benefits from having missing participants in their plans? I always debate even putting this slide in here because my goal is not to paint anybody with a bad brush, right? But the point is this, right? You could maybe argue that maybe financial institutions or custodians benefit in some way because they're maintaining, maybe or more assets under custody or under management gets to stick around. Maybe advisors sort of under that same arrangement would benefit. But the reality is, if you look at the loser side, that number one, obviously the participant is losing in this arrangement if they're missing because they're not getting the utility of their retirement savings. Certainly plan sponsors are losers under this scenario because, again, like we talked about, increased plan costs, complicates plan closures, it's a liability if they're mishandled, all those things. Same thing for plan trustees. TPAs as a service provider, same thing. And then certainly financial institutions and custodians, they also potentially are losers in this scenario because they're holding on to assets, right, that people are not around, that they're not actively managing. And anytime you're in that position, it's not anywhere I think you ever want to be with the DOL. So I would argue that kind of everybody's a loser in these situations with missing participants. And again, to emphasize, the participant's the biggest loser there, and the plan sponsor. So the point really of this slide is to simply say, look, the list of losers is much longer than the maybe short potential list of winners in this thing. So the goal again is to really paint the picture that having missing participants in a plan in any fashion is really not a good thing, and we should do our very best to try and clean those things up. Okay. Who has the responsibility to address this issue? And here's the thing, right? You can kind of go down the list of bullets here. It's not rocket science, but the plan sponsor and the trustee, they're certainly the fiduciary, so they've got a responsibility. A TPA is a paid service provider. Custodians, they're responsible for safeguarding assets. The participants, certainly it's their money. They've got some culpability in the issue. And then certainly advisors kind of playing a complementary role to, say, a TPA or a record keeper as a service provider. Theoretically, it could be argued that advisors would have some responsibility here as well. So the reality is just that there's no single entity that can point the finger and say, well, hey, it wasn't my responsibility, it was their responsibility. right? This is really an issue that is big enough now, and there's enough awareness in the industry around it that everybody should be looking to minimize this issue. All right. We'll talk about the legal guidance that exists. I'll spend a little bit of time on this slide, which is to say there's lots of deep dive stuff that you can do, but what I've done here is I've just broken down the key missing participant guidance that exists out there into one slide, right? And there's really kind of four key pieces of legislation or guidance that exists. You can see them here. They're EGTRA, 404A2 and 404A3, and then the two Department of Labor field assistance bulletins that came out. There's the 2004-02, which was the initial one. It's now old. It has been replaced, or I should say it's been updated by FAB 2014-01. So let me talk for just a minute about each of these and just give you kind of the highlight of why each of these pieces of legislation and guidance are important with respect to missing participants. So number one, EGTRA, Economic Growth Tax Relief Reconciliation Act of 2001, is what gave the ability for plan sponsors or trustees to establish IRAs on behalf of a missing participant in a plan, right? Before that, it was a theoretical thing that a trustee could do, right? A trustee could go and set up an IRA account on behalf of a plan participant. The big problem was the banks. No bank or no financial institution was willing to open up an IRA account for a person without an original signature. They weren't going to take an account for somebody that didn't exist. So EGTRA really opened up the ability and said, hey, look, yes, this can be done, and it probably should be done. So that was really EGTRA, the key piece for that legislation. That was followed up with 404A2 and 404A3, which really talked about, okay, the safe harbors around this activity. Okay, if you're going to set up an IRA account for one of your plan participants who's missing, what do you have to do? And if you do it a certain way that's prescribed by the government, then you will get essentially a get out of jail free card. So the key pieces there is that they described a number of investments that you can put the money in that would give you this safe harbor, okay? And off the top of my head, they're like FDI. It has to be an FDIC insured vehicle. You could do certain other things, but it was very limited and it was very conservative, safe type stuff. The other thing that they said with respect to these accounts is that the account had to be designed to preserve principal, be consistent with liquidity, and provide a reasonable rate of return. But it didn't identify what a reasonable rate of return was. So again, those were kind of the three big key pieces. As long as your investment was designed to do that, and then it gave you some specific investment options like FDIC insured money market type accounts, you would be in that safe harbor, and your clients, your plan sponsor clients, wouldn't ever be in danger of a missing participant resurfacing at some point saying, hey, you should have done something else with my money. So that's really the difference. That's really what 404A2 and 404A3 did. And the only difference really between the two is one talks about essentially ongoing plans, one talks about terminating plans, and the fact that there's no upper limit on those terminated plans, right? It identified, so I should have also mentioned that it identified accounts between 1,000 and 5,000 as being the target number for these plans, right? If you had accounts between 1,000 and 5,000, you could set up these kinds of IRAs if you've made a good faith effort to try and find these people. One other note on those two things. So I mentioned one already, was that if a plan is terminating, that 5,000 ceiling goes away. If you can't find somebody and you're trying to close your plan, you can set up an automatic rollover IRA or a missing participant IRA for somebody who has an account balance for more than 5,000 if the plan's terminating. The other thing to note is, why did they make a banded range between 1,000 and 5,000? It's a good question. My best guess is that there's always been the ability for plan sponsors to cash out somebody who has under 1,000, and I think that in the government's wisdom, they just didn't want to fly in the face uh, of of that. They still wanted to make sure that it was really clear that you could still do that, but for these amounts that are between 1,000 and 5,000, you should set up these IRAs. One quick side note on that was simply to say, I mentioned I would talk about uncashed checks probably a little bit. You don't want to solve one problem and create another, right? I think that's just problem solving 101. And the reality is that the smaller size checks you send out, the more likely they are to go uncashed. So if you're advising your clients to just force people out and cash out payments to them for amounts under 1,000, those checks are going to be much more likely to go uncashed. And then you get into the sort of the gray area of the uncashed check world. There's not a lot of guidance out there on this stuff, but is that still a plan asset? Is it an ongoing liability? Theoretically, the trustee is supposed to make sure that the participant receives the benefit, not just that the benefit was sent out to them, sort of all those things. So our position is this: again, in today's world, there are plenty of service providers out there now, pen checks included, that will take IRA accounts of very small amounts. So if you can follow the very clear guidance of 404, A2, and A3 and establish a missing participant IRA for somebody and have that safe harbor for you and your clients, why you would do anything else is kind of a mystery to me. And in 404A2, it specifically actually says, by the way, for amounts under 1,000, if you can set up an IRA, if you can find a provider to do that, then you qualify for those safe harbor protections there as well. Okay, so that's A2 and A3. The two DOL FABs, the important things here is that these really identified, okay, what should you do to try and locate somebody who is missing? And they really had identified four big things. There was a lot of other stuff in these things that were important, but it identified four things. It said, hey, you have to, at the very least, send a certified letter to the participant's last known address. You have to check related plan records, where potentially if the person who is a former employee, if they've updated their information with their medical insurance or COBRA insurance or provider, you might be able to find more updated information there. So that was the second thing you had to do. The third thing was that you had to send a letter to any designated beneficiaries on file. And then there was a fourth thing, and that was that you had to use the IRS letter forwarding program or the Social Security Administration letter forwarding program. So that was the key piece of the FAB. The other key thing in the FAB is that it opined against a few things. One, it opined against 100% federal tax withholding as a means to distribute this money. I actually think, side note, that this was a really kind of clever solution where somebody said, hey, look, I can't find this person. I'm going to pay them out. I'm going to pay 100% of their benefit to the federal government, right? And the federal government is going to, they're going to get that credit on their tax return at the end of the year, and theoretically, they're going to get the benefit of that money. Well, it's kind of interesting that the federal government themselves said, hey, look, we do not think you should do this. This is not an acceptable way to resolve this. So they were sort of admitting their own sort of inefficiency, I think, in a kind of a way. So anyways, so it opined against 100% federal tax withholding, and it really identified these four search steps that you needed to do. The updated FAB that came out in 2014, all it really did was it reemphasized the four search steps and replaced the last one, because by the time the new FAB came out, the IRS letter forwarding program and the Social Security Administration letter forwarding program were both discontinued and defunct by that point. So they didn't exist. So you had this guidance out there that said, hey, you must use this service, but that service didn't exist anymore. So that's really kind of one of the primary drivers for why the new FAB came out in 2014. So the new fourth measure that it implemented instead was, it said you have to at least use free internet search tools, right? And so what does that mean? It means that you basically just have to, at the very least, again, make a good faith effort. You got to Google somebody, or look them up on Facebook. And I know it sounds weird, and we're talking in the business world, but a quick side note on social media, it is wildly powerful, and the people that build those things, they're pretty smart. So if I search John Smith and somebody else searches John Smith, we're going to get different results, right? It's going to be related to things, our geographies, where we're related, my work, who I know, people I'm related to. So you do actually have a fairly decent chance of finding some people through social media, and that's really what the government recognizes, just the ubiquity of the internet now. And so they said, okay, look, if you send a certified letter, send a letter to beneficiaries and check related plan records, then at the very least you also need to use free internet search tools. It goes into more details, and I won't. It's not super important, but it does talk about things like, hey, if you have somebody with a really large account balance, you may need to look into using a paid locator service of some kind to try and find somebody, things like that. There's two other important things I think that's worth noting here, and one is that these FABs did relax the CIP guidance, right? The customer identification protocol guidance. So again, I talked early on about how banks were saying, hey, we're not going to take an account for somebody without an original signature. And what this guidance said is that, hey, look, on the back end, you still have to do the CIP, okay, but you can do it on the back end when a person comes forward to claim their account. So that helped the industry clarify some things there. And then the other thing is that in the updated version of it, the DOL actually was really, really clear and explicit about their preference for setting up these IRAs. There are some other things you can do for missing participants. They're all really bad options, so I'll just leave it at that. Because they require you to continue to be involved and administer those accounts on an ongoing basis, as opposed to if you find a provider that's reputable and follows these safe harbor guidelines, you can really wash your hands of it. So I don't under any circumstances recommend the other solutions, because again, it still attaches your clients and the trustees to that ongoing liability. But so the DOL was really clear and said that they went so far as to say, in fact, in most cases, a fiduciary would be violating their responsibility of prudence by not selecting an IRA, right? There would have to be some extenuating circumstances that would be really compelling for why somebody would choose another solution other than setting up a missing participant IRA like that. All right, so that's everything you ever wanted to know and more. Vomit, sorry, on the rules and the guidance out there around missing participants. Let's get into some of the actual nuts and bolts. What should actually be done with missing participants? Spoiler alert, here's some advice from Captain Obvious. Don't lose them to begin with. I know that sounds really basic, but it's something that's good to just remind ourselves of the basic things every now and then. Okay, now if you do lose people, and inevitably you're going to have clients who do have missing participants, what do you do? Well, really, again, we can think about it in these sort of two buckets. There's the less than 5,000, and then there's the greater than 5,000. If you've got in the less than 5,000 bucket, number one, have a well-documented procedure for offboarding, right? And that procedure should include information that says, hey, we use automatic rollover IRAs, we use missing participant IRAs, okay? So everybody's put on notice in your plans. Make sure that you've got the plan provision that allows it. I mentioned this earlier. If your plan provisions say, between 1,000 and 5,000, and for everything under 1,000, we cash out, I would encourage you to have your clients update that. And again, if you can take advantage of the safe harbor for any amounts under 5,000, I would just do that. If you get that get out of jail free card, I would absolutely recommend that rather than firing off some checks that may go uncashed and potentially create another issue. Again, make a good faith effort to find these people and then force them out. I already addressed the amounts under 1,000. So that's what you do on the stuff that's under 5,000, right? If you've got amounts over 5,000, here's our advice, what should be done. Try diligently to distribute those former employee account balances. Why? Because again, all of those reasons. The person's not there anymore. They're not a part of your company anymore. Your clients really don't need to be and shouldn't want to be responsible for anybody else's money that they don't have to be. I made a note here because it's kind of interesting. There are actually 3 ways to distribute amounts that are greater than 5,000. Number one is, I mentioned before, if the plan's terminated, that limit goes away. The second way to do it is normal retirement age. If a participant reaches normal retirement age, that's a distributable event. You can distribute their account balance. And then the last way to do it is by excluding amounts rolled into the plan. This is obscure. It's probably not going to be a very wide use case scenario, but I put it on here just so that you guys all know and you can regale your friends with some weird nuanced know-how. But if you have the plan provision that says you can exclude rolled in amounts, if somebody rolls $100,000 into their new employer plan, And during the time that they're working there, they accumulate, say, $3,000 worth of deferrals and interest, and they go missing, then the plan can theoretically distribute all $103,000 of their account balance into a missing participant IRA. All right. Let's talk best practices as it relates to what you should be doing. So certainly search using the DOL guidelines. Again, this sounds kind of obvious on some of this stuff, but these are the best practices that you really need to have. It'll make sense kind of when I get to the bottom of this. But certainly use automatic rollover IRAs when participants can't be found or when they're non-responsive. Again, I put that on there specifically because we don't make that distinction, right? If you can't find them, you can't find them. If they're just not talking to you, okay, that's on them, right? But at least you can have a defined way that you treat everybody. You give everybody the same standard of care. I've mentioned uncashed checks on here, so we certainly believe that a best practice would be to monitor all uncashed checks. The reason why is because if you are monitoring those things on an ongoing basis, you can actually recapture that money and turn those things into missing participant IRAs, right? If you make their account whole, if you restore the taxes, and there is a way to do that, you can actually turn that into a missing participant IRA where you have that safe harbor, right? If not, there are ways to deal with uncashed checks, but again, that's, like I said before, much more of a gray area. Partner with firms that specialize in locating and managing missing participants and uncashed checks, right? Penchecks is certainly one of those firms, but we're not the only game in town. There are lots of reputable providers out there. I obviously think we're the best one, but that's just my own bias. Register missing participants with the National Registry of Unclaimed Retirement Benefits. It's free. Yes, full disclosure, it's a free service that Penchecks created years ago because we just said, hey, in our mission to help provide a valuable solution and help reunite participants with their earned retirement money, we kind of thought, what else could we do? Well, let's leverage the internet. And so we created a free public use service called the National Registry of Unclaimed Retirement Benefits, and it works both ways. Participants can do anonymous searches for themselves to find money that they may have, and plan sponsors, record keepers, providers can list people with account balances so they can be found in that database. Most importantly, have a consistent process. Whatever you do, just have a consistent process with what you do. Write it down. Have that process written down in a policy and procedure somewhere. And then the last thing, and again, this seems really obvious, but follow it, right? Where companies really get into issues legally is when they have a policy, but they don't follow it. So have a consistent process, have written documentation of it, and follow it. All right. Preventative measures, and I'll just go through this really quick, which is to talk about, again, these are just some ideas for you guys to take away and things that you can talk to your clients about. It's amazing how many simple things are out there that we can do that our clients actually don't do. Okay, so a few of them. If a plan calls for mandatory cash outs or rollovers, do it promptly, right? If you don't, it could be a violation of plan terms. Do searches immediately. If you get mail returned, do a search. And there's companies out there that will help you specifically do search stuff on this, or even if it's just doing a simple, Google search of the person or a Facebook search of the person and reaching out to them online saying, hey, this mail was returned. Do you have an updated address? Makes it a lot easier to keep track of people and hang on to them. Certainly, I've mentioned uncashed checks a fair bit, so I won't belabor that anymore. But you can certainly review uncashed checks periodically and take those steps that I mentioned a minute ago to restore those dollars so that they are whole again. Once that money is whole again, it can be put back into the plan, and then it can be distributed out in the form of a missing participant IRA. Include reminders on all plan communications to update participant contact information. This seems like a really simple one, but it's an awesome, powerful one. If everything that you send out always has a footnote or always has, some highlighted box that says, hey, remember, if you move, if you change your address or, whatever, please update your contact information. That's a great one. Requesting a personal email address or cell phone number during an exit process is another really good one. We don't always have the chance to do an exit interview and have a perfect parting of ways with all our former employees. But if you do have that opportunity, certainly requesting personal contact information is a great way to do that. A lot of people just have the company email address for their employees, and that doesn't help you once they're gone. Or if it is helping you after they're gone, then you need to talk to your security people. So, and then the last one there, this is an interesting one, require beneficiary contact information, right? So a lot of times we see so many beneficiary designation forms that say, who's the primary beneficiary? Oh, it's my grandmother. Okay, well, that's not helpful, right? Require, more specific contact information, an email address, and a telephone number, something, so that those people can be contacted in that participant's absence as well. All right. The last two bits, and I will wrap it up, is the two bonus things that I promised. One is just some commentary on the PBGC's entry into the missing participant world. I talk about this all the time because people always ask me about it. They go, well, hey, PBGC's in this game now, aren't they, right? So yes, they are. For really about the last 2 years, they have opened up their program to taking on missing participant assets, but there's a few stipulations that you got to note. And so I've kind of listed them here in bullet form. Here's my short take on the PBGC. Certainly going with the quasi-government solution that the PBGC is, I think there is some inherent safety and good feeling in that. I don't actually think the PBGC wants to be in this business. That's totally my own personal opinion, by the way. Here's why. When you look at kind of how they've set it up, I just don't think it's really attractive compared to a lot of the other solutions that are out there. So number one, the PBGC program is limited to terminated plans only. So if you're going to help your clients force out small balances and things like that for your ongoing plans, you have to have some other solution for that. So if you're going to have some other solution, why you would want to jump through the hoops to use the PBGC program for your terminated plans, you could start to question that. It is voluntary, like I just mentioned, so you can use the PBGC for certain parts. You could use outside providers for others. There is a one-time setup fee. That setup fee's got to be paid by the plan sponsor directly. The PBGC will not deduct amounts from participant account balances. Most of all the other service providers out there will. You got to be all in per plan, so you can't. It's essentially the anti-cherry picking rule. You can't say, hey, for these large account balances from this terminated plan, I'm going to use some other provider, but for all these small balances, I'm going to use the PBGC, or vice versa for that matter. So if you're going to use the PBGC for a plan, all of your missing participants for that plan have to go to the PBGC. The last two are the big ones. The search efforts are still on the plan sponsor. So all of the stuff that's in the Field Assistance Bulletin 2014-01, all of those requirements to do the searching and the things that you got to do, all of that is still on the plan sponsor. PBGC doesn't do any of that stuff. Again, most of the providers out there today, their service just includes that as part of the solution. The second, or the last bullet there, which is the other really big one for me, is that the PBGC standard right now, it says that the plan sponsor must actively search for 9 months before they can move these people's balances to the PBGC. Now, I get it, and that's nice, and we would like to have a high bar that we're going to make everybody do that, but I just don't know any real-world clients that we've ever dealt with who are like, hey, it's March, we better start doing our year-end plan cleanup stuff. It just doesn't work like that. So yeah, you absolutely have to give your participants time to respond and make that good faith effort to find them. But I think this is just kind of a restrictive piece of the PBGC program that doesn't make it very attractive. So that's the skinny on the PBGC program, but it certainly is available and it is out there and can be utilized. All right, last bit here. How to grow your business with missing participants. And let's see here. Oh, there we go. Okay. So it's not complicated, but it's powerful. And it's simply this. Target plans with, call it 80 to 120 participants. The pitch would simply be, hey, if I can save you X amount of money, $40,000 today, without costing you a penny, would you give me your business? As advisors or TPAs, could you go out there and sell that? I mean, I don't know about you, but I could go sell that all day long. And the tactic is really simple. It's simply saving these plans on their annual audit costs by removing missing participants. And I put two other little footnotes to that, which is to say that removing non-missing former employee participants augments the strategy. So just because somebody still has a balance in your plan, if they're not an employee anymore, you can work with them to move their money out of the plan. If you do that, that's less participants that you have in your plan that are butting those people up against that audit limit. And then obviously timing is especially ripe during plan year end when cleanup, everybody's kind of in that mode. So, just a quick screenshot, right? I am not a spokesperson at all for Retirement Plan Prospector. But just a quick screenshot of you guys are tied into to these kinds of databases and know that this information is out there, whether it's through Free Arissa or Judy Diamond or whoever, but certainly the information exists for you to search by, geographically, where people are, by number of participants, by plan type, all those things, right? So it would make it really easy for you to find all the plans in your area that are kind of in that threshold, that are around that 100 or 120 participant mark, that would be certainly looking at or potentially dealing with mandatory plan audit issues. So I put together two examples here, right? And then this is really the last slide. And that is, look, if the cost of a plan audit on the low end, I've seen $6,500 a year. On the higher end, I've seen $13,000 plus. So just for easy math, we'll just make it a nice round $10,000. We assume that it's going to be a $10,000 deal. In this first example, I've got a company that's got 120 employees, right? And assuming a 3% growth rate every year, this is what it looks like their employee base is going to grow to. By year 6, they'll have essentially a little over 139, or call it 140 employees. If you took that same company and just did a 10% cleanup on missing participants or employees that are no longer with the company, right? That takes their total number of employees down to 108. Now they're not at that 120 mandatory audit limit anymore. And guess what? Assuming the same exact 3% growth rate and not doing any other cleanup other than that one-time 10% cleanup, you're going to extend that audit deadline by 4 years. And again, averaging cost of $10,000 a year, that's $40,000. So that's real money that you can say, hey, look, if I can save you $40,000, and again, by the way, it's not going to cost you anything. All these fees can be charged to the participant's account for finding them, locating them, and or moving their money out of their plan. Would that be valuable to you? Again, I could sell that all day long. The last thing on the right-hand side, admittedly, I put an extreme example out here. I'm not selling insurance or investments, so nobody's going to come knocking on my door telling me that I can't show you extreme examples. And I only put this out there because I was reading an article back in the August-September 2018 issue of Plan Sponsor magazine, the editor's letter. She was talking about maximizing for savings, and she wrote this, and I'll quote it exactly this. We know the assets are out there, whether these IRAs are left in a prior plan. In fact, a plan sponsor who had just done an evaluation of her plan with her record keeper recently told me she was surprised by one statistic that hadn't impressed her before. Of her plan participants, approximately 30% were not active employees anymore. So I was just thinking about that. And I thought, man, what if you could clean that plan up? So again, if you had somebody that was right in that sweet wheelhouse, right around 100, and 20 participants, if you could clean up 30%, that would take 120 participant plan down to 84 participants. And that would extend their audit, again, assuming no other cleanup, no other force outs over the next 12 years, and just doing that cleanup that one time, assuming the same growth rate, you extend their deadline before they have to really start doing mandatory audits for 12 years. You're talking well over $100,000 in savings. So again, this is one way that you might be able to grow your business, again, sort of using missing participants, if you will. It's certainly a tactic that you can use proactively to go out and find clients, and also a tactic that you absolutely ought to be using at the very least from a defensive standpoint. You ought to be looking at your book of business and looking at, geez, what's all of my clients that are kind of 80 to 120 participants, and I better be talking to them about this and making sure that they're aware of this so that somebody else doesn't come in and do the same thing to me. All right. With that, I apologize. I ran a little bit over here. We started a little bit late, but that is the short version of everything you wanted to know about missing participants. Chris?
Thanks, Spiro. We'll open up the floor for a few minutes of questions. If you have something you'd like to run by us, please enter it into the questions panel now. One question came in about the minimum audit requirement for the participant count for the number of 108. No detail beyond that, but if you want to touch on that really quick, I can.
Yeah. So if it wasn't clear, I'll jump back to that slide. If it wasn't clear, I was just assuming. I should have titled these two. Sorry. the first one says scenario 10% cleanup. The other one was supposed to say scenario 30% cleanup. So it's just assuming you took the same company, if you had a company that had 120 employees and they're going to be required to do an audit this year, and assuming they're just growing at a 3% rate, this is what their employee count's going to look like. If you cleaned up 10% of their employees, if you've got 120 employees, you very, very likely have former employees who still have a balance in the plan. They're no longer with the company. Certainly, you're going to have some missing participants, likely, very, very likely at 120 employees. So if you could clean up just 10% of those, that would take you from 120 active participants down to 108 active participants. And if that was the case and you still had the same 3% growth rate for your company and did no other cleanup, no other force outs, right, now you wouldn't cross that 120 active participant threshold until year 5. That extends the time frame 4 years before you'd have to do that mandatory audit, effectively saving you 4 years of mandatory audit costs. So that's what I was going for there in trying to juxtapose those two numbers.
Right. I guess it would also come down to you'd need to keep the plan from getting to 120.
Correct. Yeah, I'm showing these numbers right at the cusp, right? But yeah, and that's why I say kind of you would want to target. I think any plan that's kind of north of 80 to 120, and it just follows that 80-120 rule, would be ripe for this kind of thing. Even if you went and talked to somebody who's got 90 participants, right, and you could kind of show a growth rate and say, hey, in another 4 years or 5 years, you're going to be over 120 participants. Well, listen, you've got these, 12 or 13 or 10 people that are missing. If I could get rid of those, again, not cost you anything to get those out of your plan. And by the way, it's going to reduce your plan costs and reduce your fiduciary responsibility. Now, instead of crossing that 120 threshold in 4 years, you're not going to cross it for 8 years or 9 years, right? So I've just saved you $50,000. So that's kind of why I say I think there's a range of plans really kind of between that 80 and 120 mark. And yes, once you go over the 120 mark, yeah, you're done. You're a large plan and you're filing as such, thereon. But if you can catch these plans and keep them under that mark before they cross that 120 mark, I think you're golden, and you certainly can save your clients some real dollars.
Excellent. I think that was it for questions for today. Do want to make note that if everybody wants to pay attention, that Penchex is our preferred solution for small plan force outs. So if you want any more information, feel free to contact your Epic service provider, your Epic client service rep. And as a reminder, we also will be sending out a copy of today's slides along with a link to a recording of the session as a follow-up. Thanks again, Spiro, and we appreciate your partnership and looking forward to seeing everyone at our next session. Thank you, and
Absolutely.
Have a great day.
Thank you guys very much for having